happens to my RRSP when I turn 65? Or maybe you're wondering what happens to your RRSPs when you retire? If you're within 10 years of retirement and you don't know the answer to these questions, then you need to watch this video all the way to the end. Hey, I'm Hervin Pesa. If we haven't met before, welcome to the channel. I'm a fee-for-service financial planner, but here's the thing, just like you, I'm still on this journey to building wealth and financial independence so that I can live a life of meaning and impact. I share weekly money lessons that school failed to teach us, tips that will help you build your assets, retire successfully, and leave a bigger legacy. So if that resonates with you, consider subscribing and be sure to hit the bell so you never miss any of the lessons. If you need a refresher on how RRSPs work, I do groundwork and review all of that. Then I go through 4 things that you can do to your RRSP once you hit retirement. And one of them is something that I would say most people should absolutely avoid. So check the timestamps in the chapters below so that you can skip to the section that you need. Alright, let's first lay the groundwork. Like most Canadians, it's very likely that you will have 3 sources of income when you retire. Government benefits, like the CPP or QPP if you're in Quebec. There's also the Old Age Security or OAS, maybe even GIS if your income is low enough. Next, there's probably some sort of workplace pension or a savings plan that you were able to use throughout your career. Maybe even a defined benefit plan if you're lucky enough to have that. Third will be your own personal savings, the money that you sent out there to work for you. Some traditionally call this the 3-legged retirement stool. Unfortunately, there's gonna be a lot of people that are not lucky enough to have all 3. That's gonna be a wobbly retirement. If that's you, then you'll have to supplement your retirement by increasing your savings and maybe buying some real estate, getting some rental income later on in life, or perhaps starting a business. The thing is, more and more Canadians have to prop up their retirement savings through their own sources, their own resources. The Registered Retirement Savings Plan, or the RRSP, is a key retirement account for most Canadians until the TFSA was introduced in 2009. It was really the only tax-favored retirement account that Canadians had access to. But see, now it's not either or. Think of the RRSP as another prop up and the TFSA as another leg for that stool. With proper planning, you'll have support for different phases of your retirement, and we'll talk about the TFSA later. Right now, you'll likely have a combination of RRSPs from work, either the current job you have or previous employers, and then, of course, your personally owned RRSPs. Some might even have multiple RRSP accounts from different institutions and different banks. If that's you, it's probably beneficial for you to start thinking about consolidating your accounts. All right, let's review the key benefits of the RRSP. Let's say you're working and you're earning $150,000 in taxable income. That means if you're in Alberta, you'll be at the 38% tax bracket. So if you made a $10,000 contribution into your RRSP, you'll have a tax deduction of roughly $3,800. Now, while you're saving and you're accumulating assets inside your RRSP, your investments are gonna grow tax-free, so you won't pay any taxes until, of course, when you withdraw. At that point, the RRSP is added to your total taxable income and you'll pay taxes based on your tax bracket at that time. But here's the thing, if you're retired and you need a lower income to sustain your lifestyle, then it's very likely that you'll be in a lower tax bracket in retirement. But let's say at that point, you just need $70,000 pre-tax for your retirement needs, and you already have $60,000 from other sources. That $10,000 RRSP withdrawal will be taxed at 30.5% based on the current Alberta tax rates. You would pay less tax compared to the deduction that you received, and you'd keep the difference. That's roughly $750. What happens to your RRSP when you get to 65? So you've saved all this money and you finally get 65, right? What happens to the RRSP? Nothing. Nothing happens to your RRSP simply because you turned 65. The contents of the RRSP, the stocks, the bonds, mutual funds, and ETFs, all those stay the same. If you don't need it, you can leave it alone until you turn 71. Of course, that's the point when you need to convert it. But really, if you don't need it, you can leave your RRSP alone. The only time that there's a change in the RRSP is when you make the decision to retire and you go from saving and putting money into the RRSP to withdrawing from the RRSP. There are really 4 things that you can do when you decide to retire and finally use that RRSP. Number 1 is take it all out, empty it, and effectively collapse your RRSP. Number 2 is keeping it as an RRSP, draw it down slowly, taking only what you need when you need it. But you can only do this until you're 71 years old. Number 3 is you can convert it into a RIF, a registered retirement income fund. You can still draw it down slowly and only take what you need or the minimum amount. Number 4 is buy an annuity with it. Let's talk about option 1. You can try to take it out as a lump sum, but that's absolutely not recommended. Now, depending on how long you've been working at it and saving and investing, that could be hundreds of thousands of dollars inside your RRSP. We've met clients with millions inside it. Remember, the whole time that you were saving and investing inside the RRSP, the CRA has been so patiently just waiting for them to get their cut of your investments. Not ideal. Now, I'll be ignoring credits and income splitting to simplify this for us, but just imagine you have $500,000 in RRSPs and you decided to take that all out at once. You will have to declare all of that, all the RRSP withdrawal as income, and you'll owe $205,000 in taxes if you're in Alberta. About the same throughout provinces, might be higher, might be slightly lower, but that's a lot of money still. This is what happens when you pass away, by the way. Like if you pass away with a substantial RRSP balance, unless you have a surviving spouse to roll the RRSP over to, it'll be deemed as if you withdrew the whole balance in the year of death. That means your estate will have a massive tax liability. Now, a smarter way to do this would be to draw it down over time. Draw it down when you can control it instead of it being liquidated all at once. We'll have other videos about estate planning for massive RRSP balances later, but for now, just keeping it plain and simple. Unless someone has a terminal diagnosis and they have no heirs or they have no charities that they want to give to, taking out all of the RRSP in a single year is not advisable. Option 1 is a no-no for most people. That's why I put it first. In case you don't finish the video, at least you heard this. Super important. Option 2, you can keep your RRSP intact and just draw whatever you need every year if there's even a need at all. You don't need to if you don't need to touch it. Anyone can really withdraw from their RRSP whenever they want to, even when they're young. You just simply have to pay withholding taxes when you do it. You'll pay 10% for any withdrawals up to $5,000. Anything from $5,000 to $15,000, you'll pay 20% as a withholding tax and 30% for any amount over $15,000. Now, this is a good time to remind you that a withholding tax is not some sort of penalty or a double taxation. It's just advance payments for the coming tax filing next year, just like payroll deductions, right? This option makes sense for those who want to retire early, around 60, 62, where they're able to plan early enough and they use the spousal RRSP to equalize assets and split income. Now, this works for those that are retiring before 65. See, a spousal RRSP is a tax planning strategy to get deductions on the income of a higher earning spouse if there's an imbalance between earnings as you're making contributions. The higher earning spouse will have a deduction at their tax rate, and the partner with a lower income will declare taxes on it when they withdraw. Now, I said this works if you plan early enough because withdrawals from the RRSP, if it's a spousal RRSP, within 3 years will be taxed on the hands of the contributor, the higher income earning spouse, which kind of defeats the purpose of this. So you really need to think ahead if you're planning to do this. Option number 3, you can convert the RRSP into a RIF or a registered retirement income fund. To simplify, the RIF is essentially just like an RRSP. Assets grow tax-free inside it, except you will have a minimum annual withdrawal. The only other difference beyond that is that you can't make additional contributions to the RIF. The assets you hold are exactly the same. In fact, if you have an RRSP right now and you convert it to a RIF, it'll hold the exact same investments that your RRSP had. By the end of the year, you turn 71, you will be forced to turn your RRSP into a RIF. No one can have an RRSP beyond 71. The first minimum withdrawal, though, is not considered until the end of December 31st on the year you turn 72. The RIF minimum withdrawals are based on a prescribed minimum percentage according to your age. I'll pop that up on the screen right now. I'll show you the most recent RIF factor for about 5 seconds. One of the commonly used planning strategies around RRSP, if you're in a couple, is to use the younger spouse's age. You would use the RRSP minimum based on whoever is younger. This allows for more flexibility with withdrawals if you don't need as much cash flow in a given year. Let's go through an example. Let's meet Bob and Linda. Bob is 68 and Linda is 60. Bob has $500,000 inside a RRSP. Looking at the chart on the screen, basing the RRSP on Bob's age, the minimum RRSP factor is 4.55%, which is about $22,750. The RRSP factor, if we use Linda's age, is 3.3%, or a minimum withdrawal of $16,650. This is relevant because if Bob and Linda didn't need the full $22,000, they can choose to keep more of their cash inside the RRSP growing tax-free. The latest you can wait before withdrawing from your RRSP is at age 72, but you may want to convert your RRSP sooner. That's if there's a big asset and income difference between you and your spouse. This means one of you will likely be in a higher tax bracket. It's best to even out income and taxes. You can do this through income splitting. This is something that you can do with a RRSP at age 65, but not with an RRSP. So let me first highlight the main benefits of income splitting. Again, I'll ignore credits and deductions, but let's say you and your spouse agreed to $70,000 before taxes for your retirement lifestyle. If only one person was drawing that income, the total tax payable in Alberta would be $14,646. If instead you split that income perfectly to $35,000 each, both of you will pay $4,742, or about $9,400. That means $5,000 more in your pocket. That's a trip to Mexico, right? Like, that's a pretty significant sum if you're retired. I know this is an extreme, right? Like, it's gonna be tough to find a situation where there's zero income from one spouse because there's CPP and OS, but I think this does a good job showing the point, right? Now, the second reason to do the RRSP conversion early is that withdrawals are not subject to withholding if you're keeping the minimum withdrawal. And if you did the spousal RRSP and you didn't wait the 3 years, minimum RRSP withdrawals don't trace back to the original contributor. So for most people, it'll likely make sense to do a combination of 2 or 3 depending on how far ahead they were planning. Keeping some RRSP intact and converting the rest into a RRSP could make sense. So be sure to check with your advisor on what's best for you. Now, I'll do a video just focusing on the RRSP because it could get quite complex. And depending on when you find this video, that might already be available right here. Option number 4. You can use your RRSP funds to buy an annuity. An annuity is an insurance product where you essentially surrender your cash to an insurance company in exchange for a regular cash flow stream, monthly, quarterly, annually, depending on what you need. You'll receive this payment for as long as you're alive, and some even have a guaranteed payment schedule, keeping a minimum number of years even if you pass away before the guarantee expires. In this case, you give up capital for stability and guarantee. The benefit is that you won't have to worry about an immediate tax liability for this transaction, unlike a full withdrawal. You also won't pay taxes until the payouts start kicking in, and you'll only declare the income that you receive, not the balance, all right? You will have a guaranteed source of income. That's comforting for a lot of people. It's an appealing idea until I show them the current rates. Now, I rarely recommend this because the current rates are just so low. Interest rates are so low, which is used to determine what the annuity is gonna pay out. It also has a high opportunity cost, in my opinion. If you have a decent return from keeping your assets invested in an RRSP or a RRSP, you will lose that growth. And if you pass early in a regular annuity without any guaranteed payment periods, you will lose the rest of your capital, even if you've only received small payouts. I can run a quote for this, and the $500,000 RRSP will kick out roughly $26,000 on a single life. If that was invested in a RRSP instead and it was drawn over a 30-year period, the investments would only need to average 4% every year to match that. And you keep control of your cash and it goes to your estate. Now, if you're paralyzed by fear of market changes, maybe an annuity makes sense, but you need to understand what you're giving up when you choose this strategy. Now, for most people, this is because interest rates are, I know that sounds super biased, but it's just the reality of things right now. You would consider your own situation, of course, right? Now, we'll break down income splitting, annuities, and RRSPs in another video. I already did a deep dive on taxes, and you can watch that here if you need a brush up on that. If you have any questions, leave them in the comment section below. But here's one thing that I want to leave you with, all right? You can see how complex this could be. It's worthwhile for you to hire a planner or ask your advisor. They should be doing this for you, especially if they're the ones that have custody of your RRSP. Again, my name is Hervin Pesa. See you in the next video. Until then, stay aware, take control. I love y'all. Bye-bye.